Thank you for joining us in presenting our investment case for Thomas Properties Group. Our presentation covers key aspects of TPGI's business model, ownership and management, as well as provides an estimation of intrinsic value that we think is up to 5 times greater than the recent share price. We show why there is a low risk of permanent capital loss and highlight the catalysts that we think will lead to closing the gap between market price and our estimate of intrinsic value. So what is TPGI? It is a real estate operating company that owns interests in property assets, mostly office buildings, as well as operates a fee-based business. The fee business is based on property and asset management contracts related to properties in which TPGI owns an equity interest, as well as related to independent third-party properties. The property assets, all of which are located in the United States, include both income-producing properties as well as a development portfolio of mostly entitled land. Here's a look at some of the key milestones in the company's history, which dates back to 1996 when Jim Thomas, the current chairman and CEO, formed Thomas Properties as a successor to McGuire Thomas Partners, a leading U.S. real estate developer at the time. While TPGI started out owning interests in Commerce Square, a prime office property in Philadelphia, it is interesting to point out that as far back as 1999, TPGI was able to strike an advisory relationship with CalSTRS, one of the largest U.S. institutional investors. In 2002, this relationship led to the formation of a joint venture through which TPGI would significantly enlarge its property portfolio and advisory business over the following 5 years. TPGI went public at $12 per share in 2004. This is significantly above TPGI's recent share price of less than $3, which is also below the price at which it raised additional equity in 2010. Today, TPGI has 3 key components: an operating portfolio, including its interests in 23 operating properties, most of which are Class A office properties, meaning the best buildings commanding above market average rents in a particular area. A development pipeline, including interests in 5 mixed-use developments, as well as a luxury residential condo project in Philadelphia that has been completed in 2008 and is selling at the moment. And a fee-based business providing asset and property management services to properties underlying the CalSTRS joint venture, 19 properties in total, as well as property management and other services provided to third parties, which include 5 operating properties and 3 entitlement projects. Here we see that TPGI conducts its business through an operating partnership, TPG-LP. TPGI owns 75% of the partnership, with the rest mainly held by CEO Jim Thomas. As we show later in the presentation, we don't think this structure is detrimental to the interests of TPGI shareholders, as CEO Thomas is incentivized to create value for all holders in the partnership and has repeatedly shown regard for the equity value of TPGI. After this overview, let's now turn to the company's business model. As we already touched on, TPGI is a full-service real estate company, meaning it is involved in property operations, acquisitions, property development, and real estate investment management. In property operations, the key revenue sources are from the rental income of the properties in which TPGI has equity interests, as well as from the various fees associated with managing properties. These include leasing commissions, asset management fees, and property management fees. In terms of property acquisitions, these have not been prominent feature of the company's business model since the downturn in US property markets in 2008. In fact, the last property acquisition dates back to mid-2007 when the CalSTRS joint venture acquired a 25% equity stake in 10 office properties in Austin, Texas. As TPGI owns a 25% stake in the CalSTRS joint venture, this means that it effectively owns about 6% in each of the 10 properties of the Austin portfolio. While property development has been slow due to the weak property and credit markets, TPGI owns significant land and has also a majority interest in a residential condo project in the center of Philadelphia. Property development is also an important driver of the fee-based business, as TPGI earns lucrative development fees from third parties. Ongoing projects include securing entitlements for third-party land in Los Angeles on behalf of blue-chip clients, NBC Universal and Korean Air. Interestingly, such entitlement projects, when successful, have led to future property management contracts, such as in the case of the headquarters building for the California Environmental Protection Agency in Sacramento. TPGI developed the property in 2000 and continues to property manage the building. The fourth component of the business model is real estate investment management. As an SEC-registered investment advisor, TPGI advises third-party property investors such as CalSTRS on potential property acquisitions. In return, it gets acquisition and asset management fees if the property becomes part of the investor's portfolio. TPGI also benefits from such relationships as it has access to potential co-investment capital, enabling it to participate in property acquisitions that are much larger in size than it would be able to finance on its own. Bigger properties also mean higher fees if TPGI is successful in securing the property management contracts for these co-investment properties, as it has been able to do with CalSTRS. This slide updates the business model for management's new strategy outlined in mid-2011. The new strategy is a key reason why we think the stock is a compelling investment now. This is because the strategy represents the key catalyst behind closing the gap to intrinsic value, as management is focused on selling development assets as well as some operating properties that have reached their maximum value, are underperforming, or do not fit into the long-term plan. Progress on selling these assets should increase cash and allow TPGI to pay out increasing dividends, eventually allowing it to qualify as a REIT, which is management's stated goal. We estimate that the cash proceeds from announced asset sales could result in nearly $3 per share to TPGI over the next 2 to 3 years. At a current price of about $2.80, the undervaluation of TPGI becomes apparent as the existing corporate net cash already exceeds $1 per share, and upon the asset sales, TPGI would still be left with the bulk of its operating properties and the fee-based business, which combined represent multiples of the recent share price based on our analysis. But before we get into the details of the valuation, let's learn more about the company's ownership structure and management. Here we see that TPGI owns 75% of the operating partnership through which TPGI carries out all of its operations. As units in the partnership are redeemable for common stock on a 1-for-1 basis, there are effectively 49 million shares outstanding, which represent 100% of the economics of the business. Here we see that the CEO, Jim Thomas, owns 31% of the total economics of the partnership, as he owns all of the partnership units as well as 3.1 million shares of common stock. At the recent share price, the value of CEO Thomas's holdings is more than $40 million. While this already represents a large economic incentive for Jim Thomas, it is encouraging to see that he has been buying additional shares in the open market recently. It is also interesting to note that TPGI's largest shareholder is Third Avenue, headed by respected value investor Marty Whitman. Third Avenue owns 21% of the common stock, giving it a 15% economic interest in the total operating partnership. While Third Avenue owned a stake in TPGI even before 2008, it acquired the bulk of its holding in 2009 when TPGI sold 5 million new shares at $2.55 each. Here's some background on Jim Thomas and other key managers. A couple of things are worth noting. First, these executives have significant experience in U.S. real estate spanning several decades and have also worked together for many years. In the case of Jim Thomas and John Cisco, the relationship goes back to 1998. And second, Jim Thomas is 74 years old. While an official succession plan has not been announced, it appears that co-COOs John Cisco and Paul Rudder are the main contenders to succeed Jim Thomas when he eventually does retire. Given that CEO Thomas has controlling influence, it is important to examine his track record in treating other TPGI shareholders. In this regard, we have found ample evidence that Jim Thomas has concern for the equity value of TPGI and has not abused his controlling position. Examples are the new strategy announced in mid-2011, the modest compensation of top management, and a reluctance to issue much equity at low prices in 2009. Let's now look at the market valuation of TPGI and why we think that is too low relative to intrinsic value. Here we see just how depressed TPGI's share price is relative to prices before the US economy stumbled in 2008. While the share count has increased by about a quarter since year-end 2007, we think the recent share price is unjustifiably low in light of a largely intact property base and fee business, as well as the operational progress in terms of recent debt refinancings at the property level, the growth in net operating income, and progress on asset sales in line with management's new strategy. Here we see that TPGI trades at about a 30% discount to stated net asset value. Despite some impairments taken by TPGI, NAV has been much more stable than the share price collapse from the previous slide would imply. Importantly, we think that reported NAV actually understates intrinsic value, as we explain next. Based on a recent stock price of $2.78, we see that the implied market valuation is about 70% of tangible book as of September 30th, and 11 times after-tax cash flow based on trailing 12 months. While these traditional valuation metrics already indicate that TPGI may be undervalued, we point out that they leave much of TPGI's intrinsic value unaccounted for. For example, tangible book reflects properties at their depreciated accounting values, which are, in our view, lower than the fair values, as well as completely ignores the value of the fee business, which utilizes virtually no capital. In addition, the value of the joint ventures, a large part of TPGI's property portfolio, is stated at only about $10 million, which is an accounting-based measure and significantly below the economic value of TPGI's interests in JV held properties based on our estimates. Here we show why the market's perception of TPGI, as reflected in the recent share price, has not much to do with economic reality. Accordingly, the market is focused on the high debt reported by TPGI, both on a consolidated and a pro rata basis, but is ignoring the non-recourse nature of most of that debt. Secondly, the market is focused on reported GAAP net losses by TPGI, but is ignoring the fact that TPGI is free cash flow positive, as non-cash depreciation is largely the reason why the company reports GAAP losses. Third, the market appears focused on the high capital intensity and commodity-like nature of the business, but is ignoring the company's fee-based business and the experienced owner mentality of CEO Jim Thomas. In our eyes, these are the key factors that differentiate TPGI from other real estate companies. The CalSTRS relationship, which underpins the fee business, is very valuable, as is the experienced and incentivized CEO Jim Thomas. And lastly, the market appears focused on TPGI's exposure to the US real estate market, which remains out of favor with most investors. While it is true that the commercial real estate market remains challenging, we point out that TPGI is focused on the more resilient Class A office space. It owns such trophy properties as Commerce Square in the Central Business District of Philadelphia and City National Plaza in the Central Business District of Los Angeles. The company's focus on premier office space is also reflected in occupancy levels that on average remain quite high, despite the economic recession. Now that we have talked about the business, management, and how the market values TPGI, in the rest of the presentation we focus on estimating intrinsic value and the catalysts to move the share price toward intrinsic value. But before we get into the detail of our own valuation approach, we note that management provides an Excel-based net asset value workbook which is accessible on the company's website. Based on the workbook, management advocates a sum of the parts approach, valuing separately the operating properties, development properties, the fee business, and net current assets. Using management's NAV workbook, we take a rough first cut at a valuation of TPGI, which results in a fair value of $11 per share. This represents up to 3 times upside to the recent share price using reasonable inputs in management's workbook. For operating properties, we have used an 8% capitalization rate applied to stabilized net operating income. Stabilized NOI uses an operating income figure based on annualized current net operating income as of October 2011, plus an upward adjustment to get to 95% occupancy based on current market rent. Stabilized NOI is a commonly used metric by real estate investors as it reflects the potential cash flow capacity of a given property. In TPGI's case, stabilized NOI is about 15% higher than current annualized NOI as of October 2011 for the property portfolio in aggregate. Using actual NOI and an 8% cap rate, the NAV estimate of operating properties would decline from $4.34 in our table to about $3.70 In other words, this would only drag down the estimated overall intrinsic value of TPGI from $11 to about $10, still leaving considerable upside potential. In the case of development properties, we have valued the residential condo project in Philadelphia at its carrying value and other developments based on project costs incurred to date. This results in $2.33 of value to TPGI from the total development portfolio. We have valued the fee business at 8 times trailing 12 months net fee income, which results in a value to TPGI of $3.39. And finally, we have added net current assets at their book carrying value, resulting in another 96 cents of value. Taken together, we arrive at a total net asset value of $11 per share. Here we show some sensitivities around our base case value of $11 using more conservative or aggressive assumptions in a bear and bull case. The key message here is that there is a wide range of values from $6 to $18, but importantly, even using conservative assumptions, we get an intrinsic value of about $6, which is meaningfully above the recent share price of less than $3. This implies a large margin of safety. We would encourage you to download the NAV workbook from the company's website and test for yourself different scenarios to get comfortable with the low downside and high upside potential inherent in TPGI at the recent share price. Based on testing management's NAV workbook, we conclude that it highlights the favorable asymmetric return to risk profile of TPGI. However, we also observe that the workbook has some shortcomings, which we want to address next. While the workbook gives no consideration to corporate G&A costs, we want to include those costs as we assume that TPGI continues under present leadership and corporate structure. We also reduced the equity value for the Commerce Square property in Philadelphia due to a preferred equity investment by Brandywine Realty Trust in 2010. The workbook does not entirely reflect this. We also cross-check our property values versus comparable transactions and versus the implied property level free cash flow yields. We make some other adjustments in the interest of being more conservative, and we also consider the impact of taxes. So let's in turn revisit each one of these items in more detail. Here we show the value drag of corporate G&A costs that we estimated negative $1.67 per share based on a multiple of 5 times applied to the average corporate G&A costs during 2006 to 2010. Next, we examine in more detail the Commerce Square property, of which you can see a nice picture here depicting the 2 buildings that comprise Commerce Square, a prime location in the center of Philadelphia. We think that Commerce Square is the single most valuable property based on our estimated value to TPGI. TPGI owns 75% of each building and consolidates the buildings in its financials. Here we show some of the key statistics regarding the 2 buildings. The current annualized NOI is $28 million, which is below the $31 million stabilized NOI. Again, this gap is due to a current occupancy of 87% versus the 95% level assumed in the stabilized NOI figure. Stabilizing a property typically carries additional costs with it, which are reflected in the $8 million figure listed here, in addition to the currently committed $2 million which TPGI intends to spend on Commerce Square. We also note the high quality of the tenant base at Commerce Square, including many accounting firms such as PwC. There are no material lease expirations until 2014. Here we show how we calculate the value of Commerce Square to TPGI. In this case, we have applied a 9% cap rate to stabilized NOI to arrive at an estimated asset value of $340 million for both buildings combined. The implied valuation is $179 per square foot, and this approximates the purchase price paid per square foot on a stabilized basis of nearby building 3 Logan Square. Brandywine Realty Trust, another real estate company, and TPGI's partner at Commerce Square, acquired 3 Logan in 2010. This gives us additional comfort that our estimated asset value is realistic. We then subtract the total outstanding debt from the asset value in order to arrive at an estimated net asset value for the property. Well, $340 million of asset value minus $236 million of debt results in a net asset value of $104 million. We need to further reduce this figure by $25 million to reflect Brandywine's recent preferred equity investment into Commerce Square. Doing so results in our net asset value estimate shown of $79 million. The Brandywine investment is to be used for property improvements, including the $10 million of costs estimated by management to be required to stabilize the property. This leaves another $15 million of capital to improve the competitive positioning of the buildings, as we have not included this cash in our net asset value figure. Overall, these assumptions give us confidence in our value estimate of $19 per share, which is nearly half of TPGI's recent share price. Finally, we have cross-checked our value estimate by noting that it implies a more than reasonable 15% property free cash flow yield based on current NOI less interest on the debt and a 9% return on the preferred equity. The implied loan to asset value of about 70% is also reasonable, as is the ability of Commerce Square to service its debt obligations. In other words, our analysis shows that Commerce Square is a nicely free cash flow generative property that, on reasonable assumptions and in line with precedent transactions, is worth about $1.20 to TPGI. Here we show some of the other adjustments we have made to our base case valuation in the original NAV workbook. In the case of properties owned by the CalSTRS joint venture, we have fine-tuned the cap rates to reflect recent mortgage refinancings at 5 of the 9 properties, excluding the Austin portfolio. In the case of development properties, we have reduced the value by 33 cents to reflect zero value for the Metro Studio development in Los Angeles, as we include only developments that have secured entitlements to date. We have also reduced the value of the fee business by more than $1 per share to reflect a more conservative assessment of its value. Lastly, we have applied a 10% discount to net current assets and used this adjusted figure in our valuation. Here we provide some context around tax considerations at TPGI. We note that TPGI has paid virtually no cash taxes historically. Future tax liabilities should also be mitigated by available net operating losses and a pressure on GAAP profitability from non-cash property depreciation. In addition, the high cost basis for some properties and our modest value assumptions are likely to protect TPGI from paying much tax in case these properties are sold at our estimates of value. For example, the Austin portfolio properties acquired in mid-2007 are unlikely to recover the cost basis in aggregate based on our analysis. We're now ready to put everything together and revisit our initial valuation based on management's NAV workbook. We see that our adjustments have produced a reduced value of $7 per share, which is below the initial $11 value. The $7 figure represents our base case intrinsic value estimate of TPGI. However, we think that the upside potential could be even higher, while the risk of permanent capital loss is low. More detailed property-level valuation assumptions are included as an appendix to this presentation. Similar to our valuation of Commerce Square, we have built a model for each of the properties in the rest of the portfolio, which drive our valuation from the bottom up. We have some additional thoughts on intrinsic value, and in short, we think that TPGI's intrinsic value will grow over time, largely due to deleveraging effects. We think that the value can be preserved on an inflation-adjusted basis, and that it retains considerable optionality based on a large fee-based business, underpinned by the valuable relationship with CalSTRS, which in our eyes could be a significant platform to further expand the fee-based business. We have given much thought to the risks of investing in TPGI and see the following key three risks: execution risk tied to the new strategy, continuation risk tied to the relationship with CalSTRS, and illiquidity risk tied to an investment in the common stock. As we are only concerned with the risk of a permanent capital loss, we place less emphasis on illiquidity risk, although we do want to get paid for assuming that risk. The first two risks are more important in our view. In terms of the new strategy, we note that any cash proceeds from asset sales could be lower than our estimates or take longer to be realized. Also, the proceeds are likely to be reinvested by management in new property acquisitions. This leads to capital allocation risk, as a dollar of cash could be converted into something worth much less. While this risk is non-negligible, we think it is mitigated by an incentivized CEO who is intent on growing value, not destroying it. And while not guaranteed, the trough in U.S. commercial real estate markets may at a minimum prevent many of the pitfalls associated with acquiring properties in a booming market such as in 2007. In terms of CalSTRS, there is nothing to indicate that the relationship is not strong or would not continue. In fact, based on our analysis, CalSTRS did not force any onerous terms on TPGI in capital structure changes at certain JV-held properties in 2009 and 2010. Based on our assessment of the risks, we conclude that at the recent share price, TPGI investors face a low risk of permanent capital loss. We see that the corporate net cash plus TPGI's interest in 2 trophy properties alone approximates recent market value, leaving a large margin of safety due to the rest of the operating properties, the development assets, and the fee business. TPGI has no corporate debt, has minimal loss exposure to property-level debts, most of which are non-recourse. TPGI also has no major unfunded commitments. We have now made the case that TPGI trades at a significant discount to intrinsic value. While there are many stocks that trade at a large discount to intrinsic value, we think that TPGI differentiates itself by having a clear near-term catalyst that should move market value more in line with intrinsic value. The key catalyst is the company's asset monetization program. Based on management comments made on TPGI's earnings call on November 3rd, 6 operating properties are marketed for sale currently. One of these properties, 2500 City West in Houston, was actually sold on November 15th for $16 million, which is about 10% higher than our value estimate for the property in the base case. TPGI is also actively marketing the remaining 70 condos at the condo project in Philadelphia. It has sold 12 condos so far in 2011 through September 30th. TPGI is also in discussions to sell land parcels at various development sites and has sold a parcel at its El Segundo property in Los Angeles in October. In total, we estimate that cash proceeds from announced asset sales could yield about $2.70 per share to TPGI over the next 2 to 3 years. TPGI would be left with existing net current assets of about $1 per share, and the bulk of its operating properties and fee-based business, which after corporate costs would be worth about $3.50 in our base case. This represents about $4.50 of upside relative to the recent share price, or nearly 2x. As we have argued before, the upside could be much higher, while we see a low risk of permanent capital loss. We'll conclude the presentation with a few quotes by CEO Jim Thomas taken from the company's most recent earnings call. We think the comments reflect management's continued commitment to execute on the new strategy. As we have already seen some progress in delivering asset sales above our valuation estimates, this gives us confidence that TPGI is significantly undervalued by the market and represents a low-risk, high-reward investment opportunity. Finally, we want to draw your attention to the detailed property-level analysis available on the following supplemental slides. Similar to our evaluation of Commerce Square, we have built a model for each of the properties in the rest of TPGI's portfolio, which includes consolidated operating properties and operating properties held in joint ventures, of which there are 3 separate joint ventures. The first one holds just one property, 2121 Market Street in Philadelphia. The second one is the CalSTRS joint venture, which includes 9 properties, including City National Plaza in center of Los Angeles. It also includes 2500 City West, which is the property that was sold on November 15th. The third joint venture is the Austin portfolio, comprising 10 properties. TPGI has a 6% effective stake in each of these 10 properties by virtue of owning 25% of the CalSTRS joint venture, which in turn owns a 25% stake in the Austin portfolio joint venture. We have also provided some more detail on development properties, including the Murano luxury residential building in the center of Philadelphia, as well as some detail on the other development assets in TPGI's portfolio. We have also provided some additional detail on the fee business and have also provided some information on occupancy levels going as far back as 2006 and information on lease expirations for the aggregate portfolio.